returns makes it really hard for us as far as being able to analyze the financials and come up with a decision. So, I mean, in general, purpose, really define that, really have a good understanding as far as, and the banker will help you with that as far as the right product and the right fit. And then on the financial reporting side, doing all those things, you're really helping us kind of help you as far as obtaining a loan. So, and we have money to lend. I mean, it's very competitive out there in the environment. And we've got a lot of deposits that we want to, find a home for as far as on the lending side. So with that, Mr. Park, I'll pass it down the road here.
Thank you, Mr. Bosch, and thank you everyone for inviting us. SBA's function is to basically assist small businesses. When Congress enacted Small Business Act in 1953, during Eisenhower administration, it was meant to have SBA assist small businesses start up, grow, and expand, thus ultimately promote national economy and expand the tax base. So initially, I guess it was a mercenary purpose, but nowadays, I don't think we can say that with every politician talking about how to assist small businesses. Okay. I feel that we have. I see. SBA exists to assist small businesses by way of financing or by way of providing them with consulting, technical assistance, or assisting them with getting federal government contract. And my own responsibility is actually looking after our lending partners. Okay. Under SBA, Small Business Act Section 7A, SBA is to utilize private sector financial institutions to have the loans available to small businesses by way of incentive program. That means providing our participating lenders with a guarantee, Uncle Sam's guarantee, on the portion of the loan that they make to small businesses. And as you probably know, Bank of America, U.S. Bank, and all other lending institutions have been participating in our program. For our LA District Office, we have about 200 lending institutions signed up to work under the guarantee program with us. And annually, of those 200 lenders, there are about 140 lenders active, actually making loans to small businesses. For instance, for our fiscal year 2011, just ended September 30th, there were about 2,477 loans made by our participating lenders, amounting to about $1.58 billion. And it only covers 3 county areas: Los Angeles, Ventura, and Santa Barbara. And we feel that having $1.58 billion, let's see, sent to our small business community for their financing need is not any small feat. And of course, we cannot take credit for that. Those loans were made by our participating lenders like Mr. Licken and Mr. Bosch. Okay. For instance, Mr. Licken's group at the U.S. Bank made about 73 loans during the fiscal year, amounting to about $70 million. Okay. And all those efforts by our lending partners will eventually help our small businesses to expand their operations or survive this tough economic period. As you probably know, since 2008, after financial crisis globally and nationally, small businesses have been generally suffering. Their sales been reducing, and their profit has been disappearing. And it's very tough for the lending community to really continue to actively provide financing, because many of the applicants are not creditworthy enough, and especially when they are being pressured by regulatory agencies and telling them to follow prudent lending practices. With declining sales and also disappearing profit, many of actually small businesses have not been approaching lenders to ask for financing. And also, at the same time, those firms who are financially strong and be able to borrow and expand have been hesitant to actually venture to finance any expansion plans because there are so many uncertainties. So lenders are having tough time themselves with especially small local community banks. They are not really seeing too many creditworthy applicants for loan lending purposes, and also existing loans have been going sour in droves, and default rate has been rising. So banks themselves are having liquidity problems. So it's been very tough over the past few years. For instance, in 2007, our fiscal year, we had about 6,200 loans made by various lending partners, amounting to about $1.3 billion for our three county areas. But 2009, we only had 1,700 loans with $670 million. Okay. Such a drastic decrease and downturn is primarily because of financial crisis and a severe recession. However, during 2010, it turned around corner, improved slightly, and there were 2,200 loans amounting to about $1.2 billion. And for immediate past fiscal year, it further improved. So while we are not too optimistic, but we are our outlook for 2012 and 2013 is slightly brighter because of the lending community's health itself has been improving gradually. And our responsibility is looking after our lending partners. And it makes me feel much better to see most of our banking institutions are getting stronger and feel more comfortable with their regular lending activities, not only under SBA guarantee program, but through their own commercial lending. And there are less and less number of banking institutions being taken over by FDIC. So that's another good indication that we are improving. However, it remains still uncertain as to the future, immediate future and near future. I don't think anyone can really foretell, but we are optimistic, and we will do our best to assist our lending partners to make more loans, especially under our SBA guarantee program. Thank you.
Thank you. Good morning. I'm Dan Licken with U.S. Bank. The question about banking and commercial banking and getting loans, you have to really take a look at, and I look at it this way, there's a spectrum of types of businesses out there. And it's a broad spectrum. It's a spectrum from companies that are very, very small to companies that are obviously very large, the commercial banking. In my business, in my unit here in the Encino market, and Encino office in the North LA region, we cover businesses that are generally in revenue from about $20 million up to about $1 billion. So unlike Troy covers the smaller businesses, we cover the larger businesses. Then I would also segment the businesses into a couple of different ways. I always look at companies and I think, okay, are they a net borrower or are they a net investor? And a net borrower would be a company, there's two types of net borrowers. They're the companies that are not profitable. They're net borrowers. They need the capital. They need capital to grow their business. They need capital to be successful. The business owner may or may not know what type of capital they need. They assume the default is, well, I'll put what I have into it and I'll go to the bank and get a loan. So that's a certain type of borrower out there. Another type of borrower would be a profitable net borrower, and they might generate $1 in cash flow, but they need $1.50 to grow their business. That's going to occur for a period of time until they become a net investor. If they choose for whatever reason, maybe the market doesn't allow, or maybe they, by their own decision, they choose not to grow their business, they may become a net investor. At that point, they're generating $1.50 in cash flow, and they only need $1 to grow they only need $1 to operate their company. They still borrow money from time to time, and they'll have a working capital need. And then there are other companies, and we have plenty of those in our portfolio, and there's plenty of them out here in the marketplace that just preserve their balance sheets, and they ended up with a lot of cash, and they're the ones we've seen. Those are the companies we've seen that have been able to survive the downturn. So they've built a strong equity capital base in their business, and their needs for borrowing are very, very different, and they have the opportunity to take advantage of maybe a competitor or something in that regard. So the question, what is it going to take for a business to get money? It really just depends. I would go back to a lot of what Troy said. What do you need the money for? How are you going to pay it back? You know, from a bank's perspective, we look first and foremost to a return of our money. And a business owner, an investor, is going to look to a return on their money. And so we're looking, how are we going to get our money back? And then, of course, we're expecting to get a nominal return on our money. And if we do that, we've made a successful loan, and we can make another one after that. Thank you.
Got to let you get your fan base to give you the clapping. My name's Dennis Santiago, and I'm going to come at this from a little bit different perspective and try to discuss the issue of how do you go about getting a loan from the business's perspective. And because my company sells information about banks. We track basically every bank that's in business in this country. And so we talk to the regulators, we talk to the banks, and we talk to the corporations and companies and even individual investors that have large sums of money deposited in banks. And here's one of the things that just comes to me over and over and over again when the subject comes to lending. One of the things that I know about the banking system right now is that it's flush with cash. It has deposits that are parked because this economy is in neutral, and they're sitting there. And there's a ratio that you should track if you want to look at it. It's called deposits to lending. And deposits to lending ratios are such that they're over $1. And in particular, at smaller, mid-sized institutions, they're way over $1. And every time I talk to a banker at one of these size institutions, or even the larger institutions, they all say the same thing. We'd love to lend. There isn't enough demand for the cash that we've got sitting on hand. It's tough to do so. We don't know what to do because there's no conversation going with the businesses to figure out where we should target, what kinds of lending products we should invent in order to satisfy this demand. It's not that they don't want the economy to get moving again. When I talk to the businesses and the corporations, you know what I find most often? They only talk to one or two banks at the most. There's over 100 sizable institutions in business in the area. several hundred if you look at the state of California. And all of them are struggling to try to figure out how to contribute to an economy, and all the businesses are trying to figure out, what their needs are. You know what my advice is? If you run a business and you're not talking to at least 5 different bankers in order to know what your options are, you're not doing your job well enough. You need to get out there. You need to explore which of these banks, what strata in the marketplace has the kinds of products that are needed for you. Not every bank is going to be able to satisfy what you need because those business models are designed around certain targeted strata, okay? Large corporations, small lending, the same thing goes. There are banks that specialize in finding ways to make loans to businesses that are struggling, finding ways to make loans to businesses that are heavily invested in a particular community, and you got to go find them. And unless you go look for them by picking up the phone and calling a few bankers in your area, you're never going to find them. The programs are out there, and the bottom line is if you run a business, go look for it. Okay.
Very good. So we'll go ahead and start with the questions. I am going to suggest to the panelists if there are questions that you ask one another. That's also helpful for our dialogue here. I want to remind folks to speak into the microphone so everybody can hear us. So I'll start off with a question here. And we've talked a little bit about, I think, the mechanics of lending, and I think that it's pretty interesting stuff. I'd like to sort of delve into it a little bit more and ask our panelists here for their crystal ball perspective here. Are there certain sectors or industries that you see either recovering faster in this economy or have been more successful in receiving the capital necessary to sort of grow? And we'll start with Troy. Let's see what he's got to say.
I'd say, let's take this out here, make it a little bit easier. I'd say 2 that jump out at me, and the first one is manufacturing. One of the economists today was talking about the manufacturing piece, especially those industries involved in equipment manufacturing, the high-tech end, communications, those type of kind of high-skilled labor force requirements as far as manufacturing. Those groups we're seeing are doing really well. The other thing I would mention is medical, healthcare, aging baby boomer population. We have a growing population. Boom, bust, recession, whatever it is, we all need medical care, right? So those are a couple of the areas that I'm seeing some good growth in, and areas that we're having good success in as far as lending to right now. So,
if I look at the businesses that have recovered over the last couple of years, I've seen a lot of companies that have just done an excellent job across all industry spectrums of cutting their costs, right-sizing their cost structure to their new level of revenue. So business that was on track, maybe a company that was doing $20 million, let's say they did 18 in 2005, they're doing $24 million in 2008, they're on track to do $30 million. So they in 2007, they said, they set their sights on 20% growth over the year or two, and they invested for that. And they came to the bank and they said, we need some money. We need some money for equipment. We need some additional line of credit for working capital. We're buying inventory. And the third quarter of 2008, all things were going well. By the fourth quarter, everything stopped. And orders stopped, and they turned around. Now, from a bank's perspective, we felt it coming, but we didn't actually get the information because we get quarterly financial reports after it happens. So everything could have stopped in October, November, December. We didn't get that information until, the earliest of February, maybe March. And so we're seeing that dip. And there was a dip in the economy, and the businesses, the business owners, the private companies had cut their costs and align their expenses with their new level of revenue. We have come back profitably, and that's happened in consumer products. We have plenty of companies that import, design, manufacture, and import from Asia, sell their products to the companies like Best Buy and other major consumer companies like that, big box retailers, and they're doing a great job, and they're coming back and they're very profitable. Their needs for working capital are very, very low, though. I will tell you that. I'll echo what Dennis said. We have over $100 billion sitting in deposits that we can't find a home for. So, and we have, we have the desire to make the loans. I have the personal goals. I have the goals that are handed to me by my company to grow, and of course, I have the constraints in terms of credit decisions and such. But we're looking for for that kind of business. Other industries that are doing very well are those industries where there was a budgetary need for it. So it could be CapEx, it could be telecom needs, a business that needs to invest on an annual basis or maybe every 2 or 3 years a certain amount of capital expenditures, and they had to cut their costs. And they came back, and once they did that, we're seeing a lot of growth in those companies as well. Companies, value-added reseller of computer-related equipment, and it's really interesting. You can look at a 4-year history of their revenue stream, and you could see, growth, dip, and then growth and growth again, maybe 5 or 6 years. And if you normalize it, it's a normalized revenue stream. So you saw basically a slowdown for a period of time, and you're seeing an accelerated recovery in certain industries like the telecom. So I think there's a lot of opportunity out there, and there's a lot of businesses that have a great opportunity to recover and do well in the future.
In terms of industries that seem to be recovering, there actually are a number of industries that are recovering in and of themselves. You see retail, which kind of goes on an up and down thing. It kind of recovers. It recovers with the seasons. Mostly it recovers when they run out of stuff on the shelves, okay, and then they have to go buy more stuff to put on the shelves. But you see a lot of hesitation in that industry still. They hold back until the very last second, until they know exactly what it is that they need to go and buy. On the manufacturing side, if I look locally at the area, we're still a net importer of manufacturing unemployment in the area, mostly because we get a lot of manufacturing that's here finds better places to go, whether it's overseas or other states. And the area I do see, the tech area, that seems to be bouncing back a little, mostly because it's been about a decade and a half since the last time there were really major innovations in the technical world. And so there's a lot of pent-up technology that's just kind of sitting there waiting to go, and people are beginning to try to explore how to use those things. I mean, and I would say, and you see evidence of that coming out every once in a while. For all of you that have those new iPhones, everybody here that's got one of those new iPhones has a new girlfriend. And I hear she's pretty sassy. Her name's Siri, right? And but that kind of technology stuff is out there, and it's coming back. So you see a lot of investment going on in those areas. In terms of the larger manufacturing industries, the mega companies, they're still primarily, in essence, building better goods that they can offer to consumers at lower prices, and in the end, we're still paying for that convenience with the single most precious commodity of all. We're exporting quality of life overseas to do it. I don't know that any of those places are going to get any faster unless, in the end, everybody figures out that the agenda item that we need to be working on is, in order to get the economy going again, is the quality of life quotient. And we're not there yet.
If I break into a cold sweat because I'm not holding the microphone, forgive me. I'm so used to doing that from chairing a committee. So I want to drill down a little bit on sort of, the panel is about the pursuit of capital here, and I heard something that's really sort of interesting. The question is there sort of a secret, I shouldn't say secret, is there a formula here that you all are looking for? I've heard that cutting costs is important, demonstrating that on paper. I also was very heartened to hear that we're talking about normalizing sort of revenue streams, understanding sort of, you've got this sort of big dip in 2008, and looking at sort of the complete picture and the potential for a business, I think, is very good news. How much do you want to see in terms of sort of cutting costs and normalizing data? Are you looking for a 20% sort of reduction? I mean, what is it? Where is there a sort of a sweet spot for industry? Because I can't imagine that being cash flush is a good move either for the banks right now. So what more, can we drill down a little bit more on that?
Sure. I'll kind of give you our insight into how we assess a credit. First of all, we risk rate every business. And, you know, public companies, they want to go to market and they want to raise some debt capital. They get risk rated. They've got Moody's and Standards & Poor's, and they have risk rating and they have investment grade and things like that. Well, private companies are risk rated as well. And our risk rating measurement might be, let's say, a 1 up to a 9. And a 1 would be an investment grade company. It doesn't need the money. They just need it for, you know, to fluff up their balance sheet a little bit. And a 9 would be a company that's in a death spiral and it's not coming out. So we're not going to lend money to that. An 8 would be a company that we'd send to our workout. A 5 would be a good, healthy company. A 6 would be a company we would call a watch credit. It's not that we're not going to lend money to them. We have plenty of them out there. In fact, we have companies that are 7s that we lend money to. But we're watching them and watching them very carefully. And the risk rating is basically a blended rate of 3 primary metrics. And the first is cash flow. The first we're going to do, and we're going to assign what we call a probability of default. What is the probability that they're going to go into default? So we look at cash flow. First thing is cash flow. And we're going to look at cash flow whether we're lending money to a company borrowing equipment or borrowing long-term financing or even a line of credit. The second is going to be liquidity. And our measurement of how much cash do you carry, we want to see, as a rule, generally speaking, we want to make sure that a company has enough cash, and cash, we call cash and or available credit, availability on their line of credit, to cover 3 months' worth of operating expenses. So if you've got enough to cover 3 months' worth of operating expenses, if for some reason your business model shifts, you lose your customers, there's a recall on your product that you have, you've got to go into a deep dive into your liquidity. You have enough time to get out of it. So 3 months is our number. And that's just depending on some industries, you don't need 3 months. Other industries, you might need more. But 3 months is a good number. And the third is going to be leverage. And how much debt you have. And how much debt you have really you have to say, well, how is that debt structured? So we look at how much debt you have versus your cash flow, how much debt you have versus your equity in your balance sheet. So balance sheet equity is one measurement of leverage. And cash flow leverage is a number. Those are the 3 measures of our probability of default. But notice I never said collateral. Collateral, how much collateral you have is not a determinant in your probability of default. What it is it's a measurement of our loss given the default. So we call that loss given default measurement. So we measure on that. So when you really come to how do you get a loan, you make sure you've got cash flow, ample liquidity, and you're not overly levered already. Thank you.
Assemblyman, I'll follow up on the question as far as we're talking about cost reductions and what have you. I think the key is keeping the reductions in line with revenue. So if as business is fluctuating, you want to try to maintain your profitability and your margins throughout those ebbs and flows. And I like what Dan was saying earlier. 2008, 2009. I mean, 2009 was, I would say, those were the worst financials that we saw as far as our companies we work with are concerned. And in general, they've been trending up, and we want to continue to see those trends. And so, even though 2009 was a bad year, if you survived it and you're bouncing along and improving or what have you, those are all good signs. The other thing we want to find out about as well is, I don't know if we touched on or not, or what we call non-recurring expenses. So if there's one-time events that might have impacted business or impacted the operations, make sure to tell us about those. And then there are circumstances where you can add those back from an income perspective and make the financials, make those look improved. So those are just kind of my tips. You want to mention anything else?
No, I just want to ask a follow-up question. One of the things that is in particular important that when I see evaluations of particularly small businesses is the question of a second source of payment, which is essentially the collateral piece. Not so much an issue when you got super large companies, but very much an issue when you have small companies. So when those evaluations are made, I mean, you can have all the financials, everything's streaming along, but somewhere along the way they're still going to ask us. The key term there is loss given default. There's an assumption in these credit analyses that you're going to go south, and if you go south, how much money do they actually lose? So it's that backup capital that they look at, and that backup capital it gets to be a dicey equation right now because a lot of small business that backup capital is some form of real estate, and it's very, very hard to estimate what the value of that real estate is these days, and very hard to estimate what the value of that real estate is going to be 24, 36, 60 months out, because at this point in time, I mean, I look at input from all kinds of people that do these estimates, and it goes anywhere from things are going to get better to, oh, wow, we're in for a roller coaster ride we haven't even seen yet. And what that does is it adds a lot of uncertainty into the equations that they plug with. The thing I haven't seen occur yet is some sort of industry-wide strategy for how to deal with the issue of this massively fluctuating valuation on what the backup capital is worth.
Very good. All right, so that's sort of how you get a loan, I think, in a nutshell, which is really interesting. So now let's say you're a business, you're turning your inventory, you're cutting your costs, you're demonstrating that that you're on a path, you're on a plan, and you're doing well. What is sort of the thing that you want to avoid doing? What's the worst decision a small business can make, or any size business can make right now?
I've got a thought on that one.
The death spiral scenario, what is that?
Well, what I think this is just my observation from lending for over 20 years, and I've been a lender in Orange County and here in L.A. Ventura County. I was in Colorado. I was in Utah. I was in Idaho. I've been all over the western U.S. And what's really interesting, the challenges we face here in California is that the cost of living is high. Homes are expensive. Just overall cost of living is high. So what these businesses have a tendency to do is business owners have a tendency, when they start making money, they start taking it out too soon. And they raise their own standard of living too quickly. And when they do that, they find themselves taking on a tremendous amount of risk that they can't recover from if there's a downturn in the marketplace. And I have countless examples of, the entrepreneur who builds a business, he's successful, he gets his available credit, and then, the value of that first $500,000 in income or $250,000 in income, wherever you pick the number you want, is enormous. And he wants to take that. Then his personal lifestyle or her personal lifestyle gets to the point where they need to start taking out money. Or maybe they have partners and they have to, you can double that impact. And so what happens is you combine that with the availability of debt capital, i.e., our willingness to make loans, and you find that the ratio of debt to equity gets to a point that is higher than is really prudent. And I say it, I know when I said I've been lending in all over the parts of the country, that doesn't exist in Colorado or Utah because people out there don't buy Range Rovers, they buy GMC pickups or GMC trucks, and they don't spend $4 million on a house when they can afford it. They spend $1.5 million on a house if they can afford it, and their general, acceptance of what's needed for their personal lifestyles is different. That's my own observation. And so what happens is, and I've seen it out here in real estate, and most business owners, and this is actually prudent to a point, most business owners want to control the cost of occupancy. And the best way to do that is to own the building that they operate their company out of. It happens to also be, historically, been a very good investment. And in many cases, the value of their real estate portfolio, their own commercial real estate portfolio, over time, is worth a lot more than the value of their business. So if it, in times it's worked out very, very well. Well, I have plenty of examples of companies that where they took the money out, they bought 2 or 3 buildings, they run their companies out of those buildings, all of a sudden sales are off 20%. They got to cut expenses, and one of the things they got to do is they got to shut down that plant over there, but they don't want to do it because they own the building and they can't lease it out. Then everything just kind of craters. And so I would say preservation of capital, keep your profits in the company, use discipline on a personal level until you really feel like you're at the point where you can take the money out.
I'll touch on this. I think that we talked about the lack of demand right now, and there's a confidence issue and so on and so forth. The thing that if I was a business owner, I'd make sure you're not missing out on opportunities right now and being too conservative. I think that there's tremendous opportunities out there, especially when you're talking about the lowest interest rates ever. So from a perspective of making that expansion, buying equipment, as Dan mentioned, CapEx expenditures, those type of things, the borrowing costs that you can get into right now, just with the historical lows, we don't know how long interest rates are going to be this low. So that's one thing I'd mention.
So on that note, so now you're playing it safe. You're smart. You've got the good ratios. You're sort of credit worthy. When should businesses start spending money again? If you had a crystal ball, sort of where the economy is right now, when will it be safe to be out there again? I love having bankers at my disposal. That's why I asked. I'm taking furious notes here because I'm looking to do something.
Okay, all right, the reality check. It's never safe to be out in a competitive environment, because it's a competitive environment. It's a dangerous territory where you have to scratch and fight to survive. Now, in terms of when's the time to be out there, if you're a very large business right now, in terms of cost of capital, most large corporations that we work with, and we ask them, well, what are you doing in terms of getting money from banks? And they say, we don't even talk to them. Why? Because interest rates are so low, they can go to Wall Street and get money from there at more favorable terms than they can get borrowing money from a financial institution. Okay? So they go over there because they've got credit ratings, and they've got an S&P rating, right? So they can operate in that space and go work with the investment banks. And, they don't need money from regular lenders. They can go pick it up from Goldman Sachs, which is a very different type of banking in and of itself. I mean, there's an entire other segment of the banking industry that does that kind of stuff. From a small business perspective, the time, you've got these very large companies that are so advantaged, and they're capable of wiping entire industries out and have done so in the past. The time to defend your territory is while the interest rates are low enough to get in there to defend your territory. Now, you got to know what you're doing, and you got to be smart. And you have to figure out exactly what advantage it is you want to defend in the marketplace with the money that you're going to pick up. And if you misuse it, you're going to pay for it. But there is no tomorrow as far as this stuff is concerned, and there is no safer period than the period you have to evaluate right now. I mean, that's a basic tenet of business. And everybody that's in a business, a smaller business. I have a smaller business. It's not gigantic and huge. But I'm not afraid to get out there and figure out what I need to do in order to survive. And most other entrepreneurs, which is really a very large portion of the California economy and the Los Angeles County economy in particular, I don't think they're that afraid either. What they're afraid of is that they're going to go do good work and put themselves into a position based on what they know how to do, and they're going to get stomped on by a much larger company that's going to wipe out their business and wipe out their industry. That is the uncertainty that they don't know of. And that, in turn, causes a lot of hesitancy, I think, in terms of many businesses that are out there right now. They just don't know whether or not they're up for consolidation.
I would say it really comes down to your core business, knowing and understanding what your core business is, your core markets, and then the expansion. Are you expanding in your core base of business, or are you expanding into a new line of business? And there was a time a few years ago when the core business was good and healthy, but the opportunity was to expand outside of the core business and to go out and get capital in that area. I would be very careful if I were a business owner, and I would say, I'm going to expand outside my core talent base, my core experience, my core relationships in my business, You know, you could be manufacturing widgets over here and selling to a particular niche, and you say, you know, I'm going to invest capital over in this area to expand. And I know several companies that have done that, and they're not seeing the results that they expect. It could be investing in marketing. So if you can invest in marketing, you know, you're going to be increasing your operating expenses. It could be investing in capital, so you're going to be buying capital equipment. You're going to be maybe financing some of that. So the banks are not necessarily aggressively supporting the expansion outside of core businesses. They're certainly supporting the expansion within the core business. I need new equipment to modify a production line. I need to increase my inventory because I'm moving, because I've got additional sales with, you know, other big box retailers or things like that. So I would say that, you know, make sure that you are you understand your business and the risks associated with that part of it, and ask yourself if you're moving too far away from the core.
All right. Well, there's a lot of anti-banking industry sentiment out there with the Occupy Wall Street protests, assailing income inequality, joblessness, forgiving mortgages, eliminating the Federal Reserve. How realistic are these requests? What effect will they have on commercial lending? In my sort of short time paying attention, you know, in the last 25, 30 years, it doesn't seem like we've had this sort of public sentiment where it's been taken to the streets. Is that going to affect industry, your industry?
I'll pass this down. No. A lot of the conversations as far as debt forgiveness, the mortgage industry, so on and so forth, really revolves around the residential or consumer side. As far as our space, my space is concerned on the commercial front, I really don't see much of an impact as far as you know, having anything to do with that part of the business. A lot of things going on, obviously, as far as home mortgages, the residential piece, but as far as commercial, and we, you know, I'm primarily involved in owner-occupied commercial real estate, whether it's conventionally or through the SBA 504 program. But you know, I don't see much of a kind of a correlation or impact along those lines, quite frankly.
Based on our dealings with the various lending institutions, I don't think any one of those banking institutions are concerned with the current sentiment. We are hoping that it's just a passing fad. Without banking industry and financial world, I don't think Western world will survive. It's a core of our capitalistic society, maintaining democracy. So it is our, let's say, conviction that I don't think it will have a heavy impact. I'm sure it might affect maybe local elections, mayoral elections, but I doubt it will have any national ramifications. Now, going back to some of the other discussions, based on our, let's see, experience with lending partners, we've seen some bright spot during last fiscal year when we look at the average loan size exceeding $500,000 or over. Okay. It's an indication that many of the firms, especially mid-sized firms, have decided to invest and expand. That's why the loan size has been so big, primarily because they have purchased their commercial real estate property to house their businesses. Okay. Many of them thought that it was an opportune time to do so with the low price and extremely low mortgage rate. Okay. And I'm sure that will alone help boost local economy, because where there are transactions, there are always fringe benefits. And from that standpoint, we are optimistic. And also, when any firm, whether it's small or large, survived 2 years or 3 years of recent years, they do indicate they have a capacity to maintain their businesses. So if they are looking for any financing needs, okay, approach the lender with very realistic, reasonable projections and earnings forecast based on prior years, prior to 2007, and explain why the business will recover and go back to the trend that they have enjoyed over the years prior to 2007. Okay. When we work with the participating lenders, many cases we rely on our concurrence on realistic projections, and lenders are also willing to provide more time and effort in analyzing projections. Is it reasonable? Is it feasible? And does the owners or partners have capacity to carry out that promise that they will accomplish that projections or earnings forecast? So it is very important to prepare your earnings forecast along with your loan request. And your job will be persuading loan officers or credit analysts how you will be increasing your sales and improve your profit performance. And if that is largely based on projections, you need to take time and effort to make your case very solid. And lenders listen. Okay. That's our experience. Okay. Thank you.
I just thought I'd get back to this whole Occupy thing because, you know, there's a loving at the park in front of City Hall and all that kind of stuff. In terms of just how reasonable the requests, demands, whatever you want to call them are. There's a lot of sentiment there, and there's a lot of anger, and a lot of that anger is based on a feeling of deep betrayal. That those betrayals are real. That is why the entire federal system, the Federal Reserve System, the Dodd-Frank Act, all that kind of stuff, those are making substantive, real, deep changes into how banking and finance is done in this country. And they're being made because basically, from a public policy standpoint, things went wrong. And people are recognizing that. The things that have gone wrong are going to hurt a lot of people. Okay? I mean, I remember back in 2008 when this whole thing started, my mantra when I would go and give speeches was I would say to people that were still at that point in denial that something was happening, someone you know, someone you love is going to get hurt by this. And there is no way to stop it. It is still going on. These people still feel that pain. Now, some of the stuff they're asking for, I mean, it just won't work. You can't ask for everything to be forgiven. You can't ask for a total restart. That just doesn't happen. You know, if you made a big enough mistake and you refinanced your house 3 times over to 5 times what it was worth, you're going to get hurt because you were dumb. And there's no way to change that fact. Now, there are other people that are basically saying, you know, the problem that we have now in this country is we know we have pain. We know if we let that pain happen too fast, okay, we're going to get hurt even more because it's going to accelerate the problem. And we're living in a world now, you look at it, there's 2 administrations have basically been kicking the can down the road. One Republican, one Democrat. And they have both been following basically a strategy of metering out this damage in a way that does not break the country. I would not want to have been George Bush. I do not envy Barack Obama, the work he is trying to do today in order to keep this system on a keel, knowing full well that there is a gigantic amount of rotting herring sitting around on the books, not just to financial institutions, but inside the government itself. That isn't going to change. The fact that you have protests on the street to bring attention to it, it's probably not a bad thing. It probably has very little to do with the actual solutions that are going to take place. But you know, it's part of how we do things in this country. We talk about the stuff that bothers us.
Very good. Let's go ahead and open it up to questions. Before we do that, I do want to, I think, address Mayor Mario Hernandez walked into the room. Mayor, thank you for being here from the city of San Fernando. Very good. Let's go ahead and proceed with our first question.
Can you speak to startups real quick, new business ventures? Are entrepreneurs, how do the banks view new startup ventures? Are the entrepreneurs largely limited to the venture capital markets?
I would say no, they're not limited to the venture capital markets because by and large they don't have access to the venture capital markets. Unless the business is, you know, of a high growth, high technology type of a business, and the entrepreneurs have a tremendous amount of experience. I have a personal friend who used to be a roommate of mine up in San Francisco. He started a business and raised 3 rounds of financing. Last round, $30 million. Business economy went down. Business went under. Business plan, he had 13 pages on a PowerPoint. He got $5 million with a story. So he had a track record. It wasn't even a successful track record, but the VCs had confidence. For the entrepreneur, I think their access to capital is either their relationships with their vendors, their relationships with their customers, depending on what kind of business you're talking about, their own capital, by and large, their own ability to get friends and family to donate money to them and help them. I say donate, I don't mean donate. I mean, oftentimes it is a donation, but to find them the capital. And then there's the programs like what the SBA offers, which is, the SBA provides the financing that we traditionally can't provide, and we get the enhancement. We get a credit enhancement from the government. We always look for a credit enhancement in our deals, and we would get it from a personal guarantee, but we get it from the government. So it kind of moves through there. You know, it's really difficult to have a great idea and to convert that great idea into a real business. It's tremendously difficult. And for the most part, it doesn't happen. But one out of, if you look at the businesses out there in this marketplace, 87% of the companies are doing less than, I think, $25 million in revenue. I think that's the stat, somewhere around there. So, and those are the ones that survive. The ones that are doing over $20 million in revenue, they survived somehow. They made it through. They did what they had to do. They got lucky. They had a great product. They had great relationships, and they made it through. I can't speak to how to get money from a startup idea. I started a company myself with a couple. My business partners had a lot of equity capital, and we threw it all in there, and we came this close to losing it all, and then wouldn't you know it, a big company comes along and liked it and bought it, and everybody got paid off. So I don't know. But
as far as startups or newer businesses and the financing, one of that component, one of the things we haven't talked about today is, CDFIs, local groups like VEDC, and there are a number of different financing options out there. These are groups that we fund that can look at deals that we cannot do as a traditional conventional bank. But startups in general, very, very hard to do because we don't have any historical numbers that we can analyze or look at. But definitely, there's micro loan programs. There's a number of different avenues out there. It's difficult, and I think it was Dr. Watkins that really nailed it in the breakfast presentation when he was talking about how traditionally small businesses had home equity. They could leverage the equity, do a line of credit, what have you, use those funds as the seed money for the business. You get it rolling, you prove that you're profitable and have financials, then you can go the traditional bank financing route. that home equity option really doesn't exist given the state of the real estate market. So it's difficult, but I think what has really grown in the last couple of years is the growth of CDFI, Certified Development Financial Institutions, and we have great partners in the area that I would want to make sure that everybody explores.
Okay, Vic, you've got a question?